home prices, at least on a national basis, are about flat year over year, despite higher and continuing to climb mortgage rates. But certain areas around the country have seen declines. Some of them are even up to about 10%, which is pretty significant. And the last time we saw property values decline like this was back during the Great Financial Crisis. And when that happened, a lot of homeowners saw the value of the equity in their home turn negative. You may have heard this called being underwater or a mortgage going underwater. They're all the same thing. And basically, when this happens, when people's equity values go negative, it can set off a downward spiral of property prices. So the question is there risk of this happening again now? Homeowners, first of all, are they even getting underwater right now on their mortgages? And if so, could it lead to even greater price declines in the near future? In this video, we're going to find out. But before we get into this, you guys know how much I love data. But to get good deals, there's actually only one data source that you need, and that is PropStream. PropStream helps investors find motivated sellers in any market across the US with hundreds of different filters. You could search for on-market properties, you could search for off-market properties, you can run comps, you can get in touch with sellers using built-in marketing tools, and you can analyze deals to your heart's desire. When inventory is tough to come by, like it certainly is now, PropStream is the key to finding your next property. Check them out at propstream.com/BP. So let's just start by talking about what is negative equity in the first place. And I'm going to be calling it negative equity or being underwater as the same thing during this video. They mean the same thing. And basically what they mean is it's when you owe more on your mortgage than your house is worth. When you want to calculate the equity you have in your home, you take the estimated value of your home and you subtract what you owe the bank. That's the remaining loan balance. And if you are like most Americans, you have a positive value there. After you go to sell your home and pay off the bank, hopefully you have some money left over that you can walk away with. But there are some times when you actually owe the bank more than your home is worth, and that is called negative equity or being underwater. So why does this even matter? What are the implications of negative equity? Well, first of all, it's probably obvious to you, but negative equity is a really bad situation for homeowners because they will lose money on their home. But it is also a bad situation for banks because they will probably lose money on the mortgage that they lent out. And so by having both sides of the housing market here negatively impacted by a negative equity situation, it can really hurt the housing market. But we're going to get to that in just a second. But before we do, I just want to mention that being underwater, especially if you're just slightly underwater, isn't actually always a huge problem. Because if the value of your home is just slightly less than what you owe, and you're still able to make payments on your mortgage, you can kind of just wait it out, right? Hopefully the market will change. And over the course of US history, property prices have always rebounded. So if you can wait it out, then you might not have a problem. But where things really get complicated and bad is when negative equity is combined with forced selling. So basically this happens if a homeowner can't afford their mortgage, perhaps they get laid off or their income declines or some other unfortunate situation leads to a homeowner not being able to afford their mortgage and they have to sell their home because they can't stay in it because they can't pay their mortgage. Except if their home is underwater, then the bank isn't going to be very happy because maybe the person can go and sell their home, but the bank isn't going to get all their money back from giving that person a mortgage. So that is what actually creates the spiral, right? This homeowner unfortunately can't pay their mortgage. They need to go sell. And when they sell, they can't fully pay back the bank. And that's why both sides of this are negatively impacted. And this is basically what happened in the 2008 financial crisis. We all know the basics, but let me just review. So basically subprime lending led to a big increase in defaults. There are a lot of homeowners who could not afford their mortgages. And this put a lot of downward pressure on housing prices. That made a large number of homes go underwater, which capped out at a staggering 26%. That is right, 26% of homes were underwater during the Great Financial Crisis. And this was obviously terrible for homeowners who lose money from their home, but it also negatively impacted the banks because they lost money too. And when banks lose money, they tighten credit. They are less likely to give out mortgages to help stabilize the housing market. So when credit tightens, it puts more downward pressure on housing prices, creating more underwater houses. So it becomes this rough spiral, and it is something that we all want to avoid. But before we move on to whether or not this is happening today and the implications, I just want to make clear that you do not get foreclosed on for having negative equity. The situation that leads to potential foreclosure or delinquency is not making payments on a mortgage. The two things are different, and when they combine, that's when things get really nasty. But I just want to be clear, if you owe more on your loan than you do on your home, but you're still making payments, you are not going to get foreclosed on. All right, so let's talk about whether or not this is happening today. According to a few new reports, and they're really good, they show that despite some regional declines in prices, very few homeowners, at least on a national basis, are underwater. According to CoreLogic, only about 2% of homeowners are underwater on their mortgages right now. Now remember, I just said that back in 2009, it peaked out at 26%. So obviously right now we're seeing far fewer homeowners who are underwater. In fact, when you look at the state of U.S. home ownership, it's actually really strong right now. According to the same report from CoreLogic, the average homeowner has about $290,000 in equity. That is enormous. It is the most that it has ever been in U.S. history. That means for the average person who owns a home, if they went and sold their home, paid off the bank, they would walk away with $290,000, which is obviously a huge sum of money. But this data that I've cited so far is on a national level. And there are some areas where being underwater is actually more common. So if you look at this report from Adam, it actually addresses exactly what I was just talking about. The situation where a homeowner is both underwater on their property and going into foreclosure. And you can see that there are certain states that are not doing well. If you look at Mississippi, the percentage is 12, DC is at about 11, Louisiana and West Virginia are also in trouble. Then it sort of goes down to about 6%, which is still higher than you want it to be. But again, nowhere even close to where we were during the great financial crisis. So yes, on a national level, there isn't a huge issue here, but if you were operating or live in one of these markets, this is obviously a big issue. And regional differences are not the only risk factors for being underwater. You are also more likely to see homeowners who are underwater on their mortgage and facing foreclosure if A, they have multiple loans like a second mortgage or a HELOC, B, they have an adjustable rate mortgage and maybe it adjusted much higher over the last couple of years. 3, basically anyone who bought in the first half of 2022, which is when prices started to decline, or people who put really low down payments like an FHA loan where you only put 3.5% down. So just to summarize what we're talking about here, foreclosures and negative equity, they're not a big issue on a national basis. On a regional basis, they really might be. If you live or operate in DC or Mississippi or Louisiana or any of the states that I showed you above, it could have an impact on the housing market in the coming years. But hopefully, since housing prices have actually started to just tick back up in a lot of states right now, the problem might actually alleviate itself. But for me, I don't think it's something that's going to play a major role on the national level in the housing market in 2024, just in a few regional markets. But before we go, I do just want to acknowledge that if you are watching this video and you are in one of those groups, maybe you live in one of these markets or you bought in 2022 or have a second mortgage, and you may be at risk of going underwater on your mortgage, I just want to offer some advice for things that you can do to avoid a worst case scenario. First and foremost, if you can make payments, you can just wait it out. Like hopefully you're only a little bit underwater. And like I said earlier, if you are making payments, it doesn't matter to the bank if you are underwater or not. As long as you keep making payments, you are not going to be foreclosed on. So hopefully that is the easiest way out. The second thing is value add. This is a little bit risky, but if you are an experienced contractor or know what you're doing, you could add value to the property through a renovation or an addition to get your equity above the mortgage payment that you owe. That is risky, but it is a possibility. Another option is to rent out your home if it would cover the mortgage. So if you rent out your home and rent a property for less and still cover your mortgage, you can do that and wait it out, sort of like we were talking about. And the last thing is if you are in this unfortunate situation, but you still even have a little bit of equity, you could try to sell before you go underwater on your mortgage. I hope that none of you are in this situation, but I do just want to offer these pieces of advice advice so that if you're in an unfortunate situation, it doesn't get worse. All right, that's what I got for you all today, talking about underwater mortgages and negative equity. I'm glad to say that on a national level, it doesn't seem like a huge problem, but hopefully the regions where it could be a problem, that situation alleviates itself. And don't forget, before you go, head to propstream.com/BP to find motivated sellers nationwide so you can lock down your next real estate deal. I'm Dave Meyer for BiggerPockets, and I'll see you next time.